For over a decade, Metro Manila has been in the throes of a dramatic transformation. A transformation so profound it has redefined the very essence of the city. Metro Manila's skyline has been transformed, evolving from a familiar horizon into a dense tapestry of towering structures. This dramatic shift has been fueled by a relentless condo construction boom, a period of intense building activity that has reshaped the urban landscape. Cranes became a permanent fixture, silhouetted against the sky, a constant reminder of the rapid development underway. They were the tireless giants, working day and night to erect the city's new vertical neighborhoods. This surge in construction was driven by developers who raced to meet the dreams and aspirations of a rapidly changing society. They catered to a growing middle class eager to own a piece of the city, and to investors seeking passive income streams through rental properties. The promise of financial security and upward mobility fueled the demand. Condos, once a luxury reserved for the elite, were aggressively marketed as the ultimate symbol of progress and prosperity, a tangible representation of success in a rapidly modernizing Philippines. Billboards, online ads, and glossy brochures all painted a picture of an aspirational lifestyle. Young professionals starting their careers, growing families seeking a secure home, and overseas Filipino workers investing their hard-earned savings poured money into pre-selling units, eager to secure their place in the booming real estate market. They were lured by flexible payment schemes designed to make homeownership more accessible than ever before, and by the seemingly unwavering promise of ever-rising property values, a belief that real estate was a sure bet for long-term financial gain. The boom generated jobs across various sectors, spurred industries related to construction and design, and made real estate seem like a golden ticket, a guaranteed path to wealth and prosperity for those who invested early. But beneath the glittering facade of progress, the market was becoming dangerously reliant on a delicate balance of factors, a precarious situation that few seemed to fully grasp. The boom was heavily dependent on a few key drivers, especially the influx of foreign workers seeking accommodation and the burgeoning short-term rental market fueled by platforms like Airbnb. Construction outpaced real local housing needs, leading to a potential oversupply of condominium units that threatened to destabilize the market. And as the market continued its upward trajectory, the question loomed, a silent concern whispered among industry insiders. What if one of these pillars of demand suddenly collapsed? What would happen if the foreign worker market dried up, or if regulations tightened on short-term rentals? That question, initially dismissed as mere speculation, would soon become a harsh reality, reshaping the entire landscape of Metro Manila's real estate market. A major force behind high condo occupancy was the Pogo industry, which brought in tens of thousands of foreign workers needing housing. Landlords enjoyed premium rents, often paid in advance, and investors snapped up units to lease to Pogo employees. The market's over-reliance on this single industry masked its fragility. Then, regulatory crackdowns and the pandemic triggered a mass exodus of Pogo workers. Entire condo floors emptied almost overnight, and rental income streams dried up. Landlords were left with vacant units and mounting mortgages. Rental rates plummeted as owners competed for a shrinking pool of local tenants. The landlord's market flipped to a tenants market, leaving many property owners in a precarious position. The Pogo exodus exposed the risks of putting all your eggs in one basket. The rise of Airbnb offered property owners a seemingly golden opportunity, a new and innovative way to generate profit from their properties. It presented a fresh avenue for income, moving beyond traditional long-term leases. This involved offering short-term rentals, catering primarily to tourists seeking unique and convenient accommodations. And it also targeted business travelers who often preferred the comfort and amenities of a condo over a standard hotel room. Seeing the potential, many investors strategically bought condos specifically with the intention of listing them on Airbnb, viewing it as a lucrative business venture. They were drawn in by the promise of significantly higher returns compared to traditional rental models, fueled by the platform's growing popularity. For a while, it worked. The Airbnb market flourished and property owners reaped the rewards. Tourist arrivals surged, filling hotels and short-term rentals alike, and the short-term rental market experienced unprecedented growth. But this highly profitable model was inherently dependent on a continuous and reliable stream of travelers, a factor that would soon prove to be its Achilles heel. When the unforeseen and devastating pandemic hit the world, everything changed in an instant. Travel restrictions were imposed, borders closed, and bookings vanished almost overnight, causing income to evaporate for Airbnb hosts. Airbnb hosts, now burdened with empty units, ongoing expenses like mortgages and utilities, and no incoming revenue, faced a dire situation. In a desperate attempt to mitigate their losses, many rushed to convert their properties to long-term rentals, hoping to secure some form of stable income. This sudden shift, however, flooded the market with an overabundance of vacant units, further exacerbating the problem. This occurred simultaneously with the disappearance of demand from Philippine offshore gaming operators, Pogos, who had previously been significant renters in the market. The result, a confluence of unfortunate events that created a perfect storm. It was a perfect storm of oversupply, drastically reduced demand, and plummeting rental prices, creating a challenging environment for property owners. Landlords across Metro Manila felt the squeeze as their rental income dwindled and their properties remained vacant. The pandemic exposed the market's underlying vulnerabilities, revealing the risks associated with over-reliance on specific sectors and the volatile nature of the short-term rental market. The once promising short-term rental gold rush, fueled by the Airbnb boom, unexpectedly and rapidly turned into a significant liability for many, leaving them grappling with financial losses and uncertain futures. The fallout is clear in the data. Pre-pandemic vacancy rates hovered around 10–12%. Today they've surged to 17–19%, and even higher in Pogo-heavy areas. Nearly 1 in 5 condo units now sits empty, a glaring oversupply. Rental rates have dropped 20–30% from their peaks. A Makati one-bedroom that once rented for P40,000 now struggles at P28,000. Landlords' returns have been slashed, and many face negative cash flow. Meanwhile, thousands of new units are still being completed, adding to the glut. The market is overbuilt, and it will take years for demand to catch up. Both rental and selling prices remain under pressure. The numbers paint a sobering picture for investors. For many landlords, particularly those heavily leveraged or reliant on consistent cash flow, the condo market feels less like a temporary dip and more like a full-blown crisis, a situation demanding immediate attention and strategic adaptation. The pressures are mounting, and the stakes are undeniably high. Rental income has dropped, impacting their ability to cover mortgage payments and other essential operating expenses. The once reliable stream of revenue has dwindled, leaving many in a precarious financial position. Property values have stagnated or even declined in some areas, eroding the equity that landlords have built over time. This stagnation makes it difficult to refinance or sell without incurring a loss, further compounding their financial woes. And selling is tough. The market is flooded with properties, and potential buyers are hesitant, leading to longer listing times and increased pressure to lower prices. The traditional exit strategy is proving to be a challenging one. With so many vacant units, the competition for tenants is fierce, driving down rental rates and increasing vacancy periods. Landlords are struggling to attract and retain tenants in an environment where demand is low and supply is high. Distressed owners are forced to lower prices, often significantly, just to attract buyers and avoid foreclosure. This creates a downward spiral that further depresses the market and puts even more pressure on other property owners, creating a buyer's market where those with cash and a long-term perspective can potentially acquire properties at significantly discounted prices. The power has shifted from sellers to buyers, presenting unique opportunities for those who are prepared to act. But for long-term, cash-rich investors who aren't reliant on immediate returns and have the resources to weather market fluctuations, this downturn could be an opportunity to strategically expand their portfolios and capitalize on undervalued assets. It's a chance to acquire properties that may generate substantial returns in the future. The principle of buy low, sell high applies, a fundamental investment strategy that suggests acquiring assets when their prices are depressed and selling them when their values have appreciated. If you have the financial strength to wait out the slump and the patience to see your investment through to its full potential. This requires a long-term perspective and the ability to withstand short-term market volatility. The key is holding capacity, the ability to maintain ownership of a property even when it's not generating income. Can you afford to keep a property for years, covering expenses like property taxes, insurance, and maintenance, even with little or no rental income? This is a crucial consideration for any investor contemplating a purchase in a down market. If so, you might benefit significantly when the market eventually recovers and property values rebound. The potential for long-term gains could be substantial. For most, though, the risks are high and the timeline uncertain, making it a gamble that may not be worth taking. The real estate market is inherently unpredictable, and there's no guarantee of a quick or substantial recovery. The question is, are you prepared to take that gamble? Do you have the patience and resources to weather the storm, or will you be swept away by the tide? It's a decision that requires careful consideration and a realistic assessment of your financial capabilities. In this market, caution is essential, and a well-thought-out strategy is paramount. Don't let the allure of potential profits cloud your judgment. Buying a condo in Metro Manila now comes with serious risks. Prices could fall further as more units hit the market, and you might end up with a property worth less than you paid. Rental demand is weak and competition is fierce. Expect lower yields and longer vacancies. Carrying costs like association dues, taxes, and maintenance can quickly turn an investment into a cash drain. Real estate is illiquid. Selling can take months or years, especially in a buyer's market. The money you invest is tied up and unavailable for other opportunities. If you need cash fast, a condo is not the answer. Weigh these risks carefully before committing your capital. In today's market, due diligence is more important than ever. The condo crisis highlights the need for diversification. The Philippine stock market offers liquidity and the potential for high returns. Invest in blue-chip companies or index funds for instant diversification. Mutual funds and UITFs let professionals manage your money across stocks, bonds, and more. Investing in yourself through education or starting a small business can yield higher, more reliable returns. Agricultural land and corporate bonds are other options for those with higher risk tolerance. The key is to look beyond real estate as the only path to wealth. A balanced portfolio spreads risk and maximizes long-term gains. Don't put all your eggs in one basket. Explore alternatives that fit your goals and risk profile. Diversification is your best defense in uncertain times. For Filipino investors, the best advice is to do your homework. Don't be swayed by glossy ads or FOMO. Run the numbers yourself. Calculate all costs, research current rental rates, and stress test your investment. Ask, can you handle months without a tenant or lower than expected rent? If not, walk away. An investment shouldn't keep you up at night. Consider diversifying. Start with index funds or mutual funds and use peso cost averaging to build wealth steadily. Live below your means, save consistently, and avoid debt for speculative buys. Invest in your financial literacy before anything else. The more you know, the smarter your decisions will be. Secure your future by making informed, diversified investments. Metro Manila's condo market faces a perfect storm. Oversupply, high vacancies, and falling rents. Thousands of new units will only worsen the imbalance. For most, the risks outweigh the rewards. Carrying costs can quickly turn a condo into a liability. But for well-prepared long-term investors, there may be bargains, if you can afford to wait. My advice: proceed with caution and don't chase the dream of easy passive income. Explore alternatives like stocks, mutual funds, or starting a business for better liquidity and returns. Diversification is your shield against market volatility. Always invest with a clear strategy and a deep understanding of your goals and risk tolerance. The goal isn't just to buy an asset, it's to build lasting wealth. In today's market, knowledge and prudence are your greatest assets.